Hello, I'm Robert and welcome to my channel where I discuss everything automated algorithmic trading or simply algo trading. I've been asked what goes into my trading process. What do I do every morning? How do I look at the market? So let's get into those very nitty-gritty details and start with something that is absolutely critical. Before I ever start trading, I always work out my worst case scenario. Always. I start with a plan, my budget, the amount I want to use, and then I have what is actually going to be used. I figure out my finance rates, I figure out my worst case pricing, how much my margin rates are going to be, and finally I do the mathematics to figure out how many positions I'm going to purchase. In this case, my maximum number of positions for this asset is 73. And the most critical point of the entire process, I figure out exactly what I am spending, what my total expenses are, and how much my remaining amount is going to be. Everything is laid out in detail before I ever start trading. So I know every step of the way exactly what I am trading, exactly how much I have in the market, and how much I have left. Even my worst case scenario. That is when I have exhausted my entire budget. I can see exactly what that is and how much I should have left on my account. Now, of course, I've already taken into account stop losses and all of the other factors at this point as well. That is absolutely critical. Before you ever start trading, think about your worst case scenario and plan out every single position. That will save you a lot of grief in the long run. And that's the whole point of what a trading plan does. You take your plan out and then you simply execute the plan appropriately. Now let's actually get to the live trading and see what my morning looks like. And here it is. This is what I look at the first thing in the morning when I check my own trading. I see this. No pretty pictures, no fancy charts, no lines all over the place. This is where my money is at. And here is my current balance. Here is the actual amount of money I have exposed or at risk. And here is exactly how much I have left. And you'll notice what I have left is significantly less than my actual budget. That is my risk factor of using only 50% of my account maximum. Here is the current measured volatility of the market. So I know this market for Euro USD has a volatility rate of 3.8 pips. My current spread is 1.5 pips. My deviation, that is the space between my trades, is 9.8 pips. And the profit margin that I am looking to take is 13.1 pips. Everything is planned out extensively. And right now I have 12 open positions. This is how I start my morning every morning. I check. And what you see is pretty much just how boring it is all day long. And that's the way it should be. It should absolutely be boring. If you have to worry about your trades, or if you're wondering if you have enough money in your account to handle a particular news event, you've taken on too much risk. I don't have to worry about the news. I don't have to worry about what the SEC is doing. I don't have to worry about what a given company is doing and its impact on the market. Because I have figured out and planned out all of my worst case situations. I know where I should be. I know how much I should have in my account at all times. And you can see that the price is constantly fluctuating as it collects updated information. So as the market is moving in the background, all of my information is constantly being checked, cross-referenced, and verified. And we can see just how much the spread is changing over the course of time. 1.4, 1.7, so forth. This is why I don't worry about my trading, because everything is planned out. And even if my worst case situation does happen, I have stop losses just to make sure I don't blow my budget up, just to make sure I don't blow my account up. And those stop losses are fixed. Remember from the previous screen that I calculated my budget out by 73 levels. Well, I'm only at my 12th level. So I have a long ways to go before I'll ever hit a stop loss. And because of the way the market is spaced out, deviation plus spread plus volatility will give me a huge boundary between positions. And that's the important part. For example, we're looking at, let's say 4 pips, roughly 2 pips is 6 pips, and 10 pips. So roughly 16 pips per position. Now I have a rough boundary of 73. So let's just cut that back to easy numbers. The market has to move 730 pips before I hit a stop loss. Now a normal average month is only about 450 pips. One entire month in 21 years of analysis shows the market moves about 450 to 480 pips. So what you see here is a long-term plan to prepare for the market no matter what. And I emphasize long-term. Most people that use a grid trading technique don't think long-term. And most people that sell grid trading techniques on YouTube don't want to make you see the long-term connection, because they're just trying to take your money. You need to think about grid trading as a long-term situation. If you're in the market for a few hours to a few days, your risk level is over the top and dangerous. You need to think about holding and being in the market for at least 1 year. If you can't handle a market fluctuating for at least 1 year, you shouldn't be in it. And that means you need to look at the history of the market and make sure that history gives you the range. But this is my morning, right here. Here's where I start. Now, after we've done with this, I go to my demo accounts. And in my demo account, where I'm running multiple tests, as you see from my Discord server, where I post the results and have been posting results, I spend a lot of time just watching these and watching trades, buys, and sells. Each one of these accounts has a different setup and setting that gives me different levels of information within the market that I use for my real trading. Part of my risk management, part of my market outlook comes from my demo account. And this is absolutely critical that you have demo accounts running. You should have them going all the time. That way you can make changes here and see how it impacts the budget of an account. You can see if something is hyper aggressive, hyper defensive, or just right for your own personal risk assessment. And you have the ability to actually be able to tune and test safely. I spend probably a good 15 to 20 minutes at least just watching the market at the height of the back and forth trading, which is usually 10 a.m. to 11 a.m. my time. So it's a simple process, but you see it is very effective. And you even see, like here, no volatility. Here I actually test the volatility. So you see exactly how I track and test various variables. And you see the impact of those variables on the budgets that are being simulated. Now you see how trades take place through selling and reduction. And you see how those mechanics play a part of the process, how they work through everything, and how I'm able to actually see how long I held a position and my expectancy of profit versus the reduction rate of loss. Again, using this technique is a way I mitigate risk in a market that is filled with risk. Now we get to the most important part of my trading. The absolute most critical step in my morning regiment is watching the order book. If you don't pay attention to the order book, you're just gambling, plain and simple. If you're not paying attention to what is going on here, where the buyers and sellers are actually located, you're not making informed decisions about your trading. So the very first thing we're going to do is go to the volume table. Let it load, and we will be greeted with the volume levels. And here we see that the volume levels paint where the support levels are and where the resistance levels are. Pay attention to these numbers. They are very important. Support is at 1.069. Let's talk about what that means. That means that all of the orders in the order book, right now 7% of the order book wants price to drop to this level. This is where people want to buy in the market. This is very critical when you're looking to place a stop loss. Do not ever, under any circumstances, place your stop loss on the support level. You will be wrecked if you do. The support level is where people want to buy. This is the price they want to see. This is where they're trying to push price down to get into the market at a good rate. The resistance level is where people want price at to sell. That way they can get out of the market with a very nice profit. And we can see from the ticker levels that we're not that far away from the resistance level. 96 to 99, you're looking at about 30 pips. So that is not really a lot compared to where people want the price to go down to get into the market. You're looking here at roughly 20 or so pips. So that's important that you see the differences between support and resistance. Now, keep this number in mind. This is important because I'm going to show you something about the order book that is very critical. If you aren't actually paying attention to this, it could cost you money, both in the short term and the long term. 1.069 is where the buyers want the price. Now let's go to the frequency table and actually see where the price is. And that is right here, right now, by count, by market observation, by actually seeing where price is at. Current price has a high probability of going to the 1.095 range. Now that means that throughout cycling the market, buys and sell orders, the ticker has been around here. And this is important. We can see that the support level is the same. And there's really no difference in this zone. Operative words here, zone. This is important to understand that this zone has 10 pips in it. So as you look at this particular table, we see where the prices are. That's a very big difference from 1.069, which is down here. Price has not been here since this program has collected its samples, and it currently has 172,000 samples. So while the order book volume itself shows that the buyers want 1.069 as a price, the actual market participants show that price is hovering around 1.095. This is where the actual price is being recorded at in the market through buys and selling activity. So now let's go to the actual weighted. The weighted table is volume times count. And that shows us the overall bigger picture of where the market is right now. At this moment, live. And that's something that I need to make sure you understand in looking at this data. All the data I've shown so far, even my own trading and my demo accounts, this is all live data happening at this moment right on the spot. So now, as we look at the volume multiplied by the count, we get the weight of the order book. And right now, the actual weight of the order book is at 1.091 for the buying price. This is where the price and the volume match up to show the highest level of activity. That is, this is taking what the people want out of the order book and it's comparing it to what people have actually done in the market to give you an idea of where most people are buying right now at this moment. And right now, 1.091 is the most active buying price and also the most active support price. So if a lot of people buy here, then you will see price climb up and bounce off of the support level. Whereas if a lot of people sell here, you will see price drop and bounce below the resistance level. And we can see that right now, the order book shows the resistance level at 12% of the entire order book. based upon counting prices and actual order book volume. Whereas right now the buy side is 14% of the order book of where people want price to be versus where price actually is. And of course we can see the overall range. That is, how active has this order book been? What is its depth? Well, in the last 48 days, the lowest the price has been 1.078. So for the order book to drop down to 1.069, which is what the actual volume shows, the whole market has to move downward quite a bit. So this shows you the struggle between the bulls and the bears on a very micro level within the order book itself, where you see how weight and the dynamics of buying and selling play together to give you a much broader and bigger picture of the order book. Let's go back to the volume table and look at the actual volume levels of where people have put their buy and their sell orders in. Now these could also be take profits, these could be stop losses, these could be buy limits, these could be trailings, so forth. But you see that the order book, 1% is at the 1.99 rate. So 1% of the entire sell side is at this price. Now overall, when you look at the whole of what you see on these columns, that's not really a significant amount. Comparatively speaking, it looks rather weak when you look at all of the different percentages here. It's the strongest percentage, so it's the most probable, but it's not necessarily going to be an absolute. That is, it's not necessarily something you can count on, meaning that you should see this as a weak resistance within the order book. Contrary to that though, 1.069, where people want price to go to. This is fairly strong. This is 7% of the entire order book. And you see, by looking at this table, it's very, very much well above every single order here. So that tells you there is a huge amount of support for this area. Because of that, it is extremely strong. So this looks like it's going to hold quite aggressively, meaning price will probably respect it if price does actually drop to this point in the foreseeable future. Now, of course, remember that the market is dynamic and these values will change and fluctuate. In fact, you can expect the support level to go up if price continues to go up. Likewise, you can expect to see support level go down if price continues to go down. But for the most part, here is what people want to buy at, 1.069, and people want to sell at 1.099. So, focusing on how you handle your trading, always look at all of the information in the order book. And when you see the kinds of discrepancies like I've demonstrated here, understand what this really means inside the order book. Understand how it plays a role in the market dynamics between buyers and sellers. For example, when we look at the frequency table, we can see here where price has been consistently, and then when it starts dropping off. These are important considerations because this tells you that the highest reasonable price within a block has been at the 1.096 range. So this can be a soft resistance because then you see the amount of prices drop down quite significantly in terms of where the market has been. This doesn't mean the market can't go back up to this position, but it gives you a reasonable soft resistance level to look for on the charts. That is, where have the bears set up shop to try to keep price from going above? Well, that's 1.096. Subsequently, looking at the buy side, you can see where the bulls has set up shop to try to keep price from dropping below. They don't want the price to go below 1.091. So as you see the dynamics between the bulls and the bears play out, you now have a market range by which they are working. You can see where they are pushing the orders both on the buy side and on the sell side to try to maintain that control and influx within the market. And we can see clearly how price drops off here in terms of frequency. So even though we have the potential for price to drop lower, the smaller these numbers are, indicate the less likely probability that they're going to happen reasonably short term. Not to say that a longer term they can't happen. And we've seen cases where a market could easily drop 30 pips in one day. But realistically, you could see the pressure of that kind of a drop exhibited within the order book. And finally, back to the weight. The weight itself, the overall picture, this is absolutely critical in that you can see just where the market is concentrating, both by count and volume. Whereas here we can see the 1.099 on the resistance side has 10% of the market. So again, this could be a soft resistance if this resistance level is broken. So you can see how the bulls are pushing this resistance level and the bears have set up a higher level resistance just in case. But here you can see there's not much support outside the 1.091 level. As you see, if the bears can break this support level, there's no fallback, which is going to leave the bulls scrambling to get back into the market as much as you can, or as much as they can. Now we see a couple of higher points here at 3%, but quite frankly, compared to the current level of 14%, I don't see these as much of a challenge in the market. So realistically, the bulls have pretty much drawn a line in the sand, and that line is where they're pushing. Whereas the bears have a contingency plan, and that contingency plan is just in case, where they have a few other smaller layers that realistically they're not going to hold. But here at 1.099, they have a much bigger resistance level that will likely hold again. So think about the dynamics between the bulls and the bears, the buyers and the sellers, as you plan out your trading, as you look at your trading paradigm in general. Always plan for the worst case scenario and always think about that as you trade. For example, if I wanted to set something up with a stop loss, well, if you're looking at a stop loss and you say you buy in right now, well then right here would probably be a good take profit. But a stop loss would probably be down here. And if you really wanted to be defensive, you would go where price hasn't been for quite a while. So we have 48 days of data that says price has not been here, no matter what the actual volume shows in the order book, which is at 1.069. But you could go down to that and be even safer. So you can see how examining and analyzing the order book is absolutely critical in planning out your trading. If you're not using a floating grid kind of situation or some kind of an accumulation approach, not looking at or utilizing the order book is just gambling. Do not trade without understanding the dynamics of the order book. Now you'll notice in all of this that I've done for my morning regiment, I have not looked at one single chart. And I don't look at the charts when I want to see what the market is doing. Pretty little pictures get in the way. It's easy to be mesmerized by all the colors and lines. It's much harder to lose sight of reality when you see the hard, sharp numbers in front of you. Take advantage of the order book. It is probably the number one asset that any exchange and brokerage can give you, because with it you can learn a huge amount about what is actually going on in the market at the moment. And right now, this very second as I am recording this video, this order book is updating live or near live, because it takes 5 seconds to download the entire order book and process it. So you'll see the screens change, you'll see them fluctuate, and you'll see them actually go through the process. So let's go back to the volume, and then I'm going to go to 5 digits. We'll actually see the order book fluctuate much more aggressively. And we see now at 5 digits, slightly different numbers. Why? Because I do a little bit of rounding when I move down precision. That is, I aggregate my numbers to give me a much broader picture. So now you get an idea of just how weak this resistance really is compared to anything close by. And you can see here just how strong support is compared to anything else. And this is the whole point. And you can also see in the order book, yes, unfortunately there are crazy things that go on in the order book where you can actually see manipulation. And the market shows 4% of the order book wants a price of 16 cents. That is correct. And that's one of the dangers of using volume alone. Because if you don't use counting and weighting, you will see manipulated numbers like this. And this is also why I use precisions such as 3 is my common value, because it limits the amount of manipulation that I see in the tables. But as you can see, manipulation is there. Manipulation is readily available, and it is a problem. And that's why you need to look at frequency counting and frequency weighting to help you sort out the manipulation of the market. So, as you use your tools, use the order book. I cannot stress this enough. Take the time to read the order book. It is absolutely critical. Trading without using the order book is gambling. Bottom line, no exceptions. You are given a wealth of information here. Take advantage of it. If you like this video or like the content of this video, please give it a thumbs up. Hit that like button. If you're not subscribed and you want more information like this, please subscribe to the channel because I routinely go through this kind of stuff. I show what really goes into real algorithmic trading. Not games, not gimmicks, not by fly-by-night garbage, but real content you can use on a daily basis to help you trade better. Thank you for watching, and until next time.